All right, good morning, everyone. We wanted to thank you for attending our second annual webinar to discuss the Gray Employee Benefit Plan Survey. I'm glad you could take time out of your morning to hear what we have to say. So my name is Marty Kirshner. I'm a manager at Gray. I've been here about 10 years, and I help head up the Employee Benefit Plan Practice Service over here at Gray.
Hi, and I'm Jim Donellon. I'm a director at the firm. I've been with the firm for about 12 years, and I also work with Marty in leading our benefit plan practice.
So this is the second year of the survey, and we had about 100 plans participate this year, which is very similar to what we counted in last year. Very similar demographic. A lot of plans in the Northeast region of the country. It's specifically focused on plan design. So if you have questions as it relates to your plan with investment returns, we're happy to provide that information offline, but this is specifically designed around the plan design. So, this year what we wanted to do as part of our deeper dive is take the survey data and drill down to how this data can lead to common issues that we see when we're performing our employee benefit plan audits and give the audience some insight as to how to avoid these issues. And these issues apply to plans whether you do get audited or whether you don't get audited. So it's our intention to make this presentation as interactive as we can and worthwhile to you. So prior to the webinar, we reached out to you and asked you if you had any questions or items you wanted us to discuss, and we tried to incorporate that into our presentation. However, if you have additional questions throughout the course of the webinar, do not hesitate to ask. We're happy to answer any and all questions. So just to give a high-level view, this is what the average plan size was of the respondents. As you can see, 83% of the respondents fell into that $1 million to $100 million bucket. And in total, when looking at this, the average plan size was around $49 million. And this is actually up from last year, which we mostly attribute to the positive returns that we saw both on the NASDAQ and the S&P. If you are interested in drilling down on this data to get information more relevant to the plan size of your plan, please ask us offline, and we will be happy to help with that. In terms of number of participants, so 80% of participants fell into the 100 participant to 500 participant demographic. That makes sense given what the average plan size was. As I mentioned in the beginning, it's important to note that despite the size of your plan, whether you're a 4-person benefit plan or a 4,000-person benefit plan, the fiduciary responsibilities don't change, and the plan needs to be run with the same level of discipline and care. The last thing that you want to happen is the IRS or the DOL coming in and looking at your plan and finding flaws, and it just leads to a long, arduous, and usually monetary process that no plan is exempt from. Taking it a step further, as we see here, this is the breakdown of the demographic of the industries that make up who responded to the survey. The majority of the participants fall into the professional service category, which is typically your law firms, your engineering firms, and your consulting firms. And what we typically see when we're scanning across the industries is drastic differences in plan participation based on what industry you're in. The professional service firms typically have higher participation rates, while when you're dealing with manufacturing companies, education companies, and retailers typically have lower participation. And typically that's because of the result of the demographic of that workforce. And what it really can do is create issues for high-level executives in the company that have these low participation plans, because eventually they become too top-heavy, and the executives in the company aren't allowed to maximize their retirement benefits. We'll kind of allude to this later. We have a couple slides on non-discrimination testing and some ways to get around that. But again, based on this slide, if you're industry specific on here and you want more information about how plans are run within your industry, again, we can provide that information after the webinar. So first slide is about matching contributions. So 64% of the respondents to the survey said that they pay their employer match on each pay period, and the remaining 36% of respondents fund their match once a year. Whether you decide to fund the match on each pay period or once a year is really just a matter of cash flow, but the dollar amount that are going to participants wouldn't be affected by this decision. These matches are also based on employee deferrals. Many plans out there do a profit sharing plan, which is really more of a function of your compensation. And I think next year when we do the survey, we want to incorporate more profit sharing questions, because I think the data can be more valuable, because some plans say they don't do a match, but in reality they're giving employees the benefit, but it's based in the form of a profit share rather than based on their deferrals. The tiered match is actually the most popular type of match that we see. It's when it's like So that in this case, it was 50% of employee deferrals up to 6% of employees' compensation. That was the most popular match that we saw. The most common flat dollar amount match was $2,500. Now, you could either say that we're going to match $2,500 of deferrals, or you could even have a match that says we're going to match 50% of employee deferrals up to 6% of employees' comp with a cap of $2,500. So there's multiple ways to get there, but in general, when there is a cap, that dollar cap was $2,500. Otherwise, you can do safe harbor matches, which they're the most expensive, and that's when plans are typically matching 100% of the first 3 or 4% of compensation. And again, when we go into discrimination testing, that's a workaround that plans will do to make sure that all employees in the company are able to maximize their retirement benefits. In terms of vesting, so this is one of the questions we received prior to the webinar. So 30% of plans that responded had an immediate vesting in their employer match. And the lion's share of those plans were safe harbor plans, because when you're a safe harbor plan, it's actually mandatory to have 100% vesting in those contributions. When you start to look at the cliff vesting, though, most plans won't fully vest employees until they've been there for at least 5 to 6 years. This is actually a really good business practice, because at the end of the day, this is free money that the employer is providing to the employee as a benefit, and it serves as a good retention tool for employees. So, you know, the other good side of having the cliff vesting, it allows for accumulations into your forfeiture account, which can be used towards funding future matches or future administrative expenses of the plan, such as your audit. So to have a cliff vesting will allow the company to reduce future cash flow issues that they might have from having to fund the match by having accumulations in this forfeiture account.
So we just wanted to touch upon some common issues we see when we're auditing plans each year. So every year we're auditing approximately 80 benefit plans, and these plans consist primarily of 401k plans, 403b plans, ESOPs, and we're still seeing some defined benefit plans out there. With this experience in auditing all these plans, we have noted some consistency in the issues we often see with plan operations and design. And these issues are plans of varying sizes. It might be a plan with 80 active participating participants, and there's some that have thousands of employees. So it's all over the map, but we often see similar issues regardless of the size. And while not all plans need to be audited each year, all plans still need to operate in accordance with their plan documents and in accordance with the IRS and DOL regulations. Over the next few slides, we'll discuss these common issues and how to avoid them. So one of the big issues we often come across is eligible compensation. And the key here is knowing the plan document. The plan document is what governs the plan operations. Eligible compensation is something that is specifically outlined in the plan document, and that should specifically be followed to ensure the plan is operating properly. We recommend ensuring the various compensation codes are set up properly within your payroll system, so there's not a manual process of calculating eligible comp each pay period. The key, though, is when the codes are set up, they match what the plan document outlines. And this should be checked periodically in case there was a mistake, or there was a plan amendment that modified compensation, or there's new compensation that hasn't yet been coded. Oftentimes we see where maybe there was a bonus and somebody was unsure how it was to be treated, so they sort of default to not deferring on it. And that's really not the way you need to do it. You need to look at what the plan document says, because if you're not following it, these are errors that need to be corrected. And besides the fact that it might cost the company some money in correcting it, it's also a lot of administrative time and fuss of fixing this. And you don't want that happening to your employees. Are important. You don't want them concerned about where their retirement money is going if they're missing out on any opportunities. So 3 things that are sort of non-recurring that we often run across are the bonuses, overtime, and commissions. So this is something you have to be mindful of and make sure that whoever's handling this part of the 401k plan administration, that they're aware of the plan document and how to handle these. So in terms of our survey respondents, in terms of bonus comp, so 85% of the plans that responded to us, they allow bonus comp as eligible, which is a nice benefit for the participants to be able to defer on this comp that may be above and beyond what they're expecting to be paid during the year. However, be careful to avoid the common pitfall of erroneously not deferring on bonus comp if the plan allows for it. On the other hand, if bonus comp is not eligible under the plan, you cannot override this and allow participants to defer on the bonus, even if they are coming to you and requesting to defer on it. Some plans also allow for separate elections for bonus comp. And when you have this, make sure that there's some sort of a trail of how this is being done, whether the participant does this in writing and submits it, to HR or whoever's in charge of the plan, or there's an electronic version that they're doing via the plan's website. You could also consider having a default election if the separate election form isn't returned, whether it be it defaults to no withholding or defaults to the regular withholding elected for all the other forms of eligible comp. This is important to have just in case a participant comes forward claiming they missed out on an opportunity to defer and to support the plan operations in the case of an audit. This is also assuming these elections don't conflict with any other aspects of the plan document. Besides bonuses, some other types of comp you often see mishandled are overtime, commissions, stock comp. Whenever you're unsure, always check with the plan document or your plan advisors for help. This is an important benefit for your employees, and you want to make sure the plan is operating properly. Not only is it helpful to the participant, but it also helps the plan sponsor avoid additional costs associated with lost earnings, penalties, additional inquiries under audit. And besides potential penalties, it also takes up plan management's valuable time to be correcting these mistakes. Again, we'll keep kind of driving this in, is that the key is to know the provisions of the plan document and to ensure the payroll system is accurately coded to properly calculate eligible compensation. And periodic reviews of the system should take place to ensure it is working properly.
So here's an actual image of what your plan document would look like to help you determine what is included and excluded from eligible compensation. This was actually taken right out of a plan document. Notice here on this example, though, that there's only one item that is excluded for reimbursements, and that's what's called the reimbursements for other expenses, allowances, and fringe benefits. So as you can see here, bonuses is not checked off as excluded, which means that that is included. It's very important that you look over this because, again, this, as Jim alluded to, is one of the most common areas that's missed. People just blow right past this part of their plan document and are either improperly including or excluding these types of compensations in their plan, in their payroll, and that's just because that's how it's always done it. And you know, it's hard in some cases when your plan hasn't been audited because you don't always have that additional resource to come in and kind of take a look at it for you. So it's something that if you're in that situation and you're not being audited, you definitely want to take a quick look at now or have someone take a look at for you. The second question is really more specific to whether you have separate deferral elections on bonuses. As you can see here, the answer is no for this particular plan. So while this kind of seems fairly simple and obvious, you'd be surprised how many plans will fail to enact that properly. I actually had a client who, you know, they typically give out cash bonuses around Christmas time, and they always intended that bonus to just be a, you know, a nice $500,000 cash check that they can have around the time to spend on whatever they want. But ultimately, what they failed to recognize was that small little cash bonus was eligible compensation for purposes of the plan document, and they actually should have been withholding 401k on that bonus because they also didn't have a separate deferral election. And because of that, when we came in to do our audit, it was determined that, you know, all the bonuses that had been paid out over a period of time probably should have had these withholdings, and they had to take the necessary corrective action to get themselves back into compliance. This next slide is a different kind of issue that we see, and it has to do with whether or not you're required to fund a true-up on your match at the end of the year. So as you can see here, this box is checked off at the end of the plan year. So what that means is that your match is based on your deferrals and or contributions over that entire plan year and not necessarily what is done over that pay period. If it was checked off as pay period for matching contributions, then you're only required to match what is deferred on or what is compensated on any individual pay period. This can get kind of confusing though in both situations because in both situations you could be funding your employer match on each pay period, but the key term here is contribution period. Is the match only based on what you deferred for that one period in each subsequent pay period, or is the match based on your deferrals and or compensation for the entire year? You know, typically employees that max out their contributions before the end of the year or defer a really high percentage of their payroll on a given pay period are the beneficiaries of the true-up. But if you do have a true-up and you don't even know it, it can become an expensive funding that has to be made on a one-time basis before the end of the following year. I think within September 15th is the deadline to get that in. So I would make sure that you all take a look at your plan document and see what you have checked off here, because if you do have plan year checked off and you're not making that one-time true-up contribution in the subsequent year, then there's a chance your plan might be out of compliance. And again, some of this stuff, again, it's compliance related, but this is based on information that we see in the survey because people are, the most popular type of answers are people that fall into these types of plans that have these issues. So we wanted to take the data and tell you how it can really impact you. So switching gears now, we want to talk about hardship distributions. As you can see from the survey data, 86% of the plans allowed for hardship distributions. So it's become a really common feature in plan nowadays. The most common types of hardships that we come across are medical expenses, buying your residence, usually it's your first residence, avoiding foreclosure of your home, funeral expenses, or post-secondary education. When you take out these hardship distributions, you're subject to a 10% one-time tax on that distribution. And the point of the distribution is really to address an emergency financial situation that you've encountered. It's not intended to be a quick fix that gives a participant some cash for their upcoming Vegas trip. Plans really don't want for that. The DOL and the IRS's intent is to have everyone keep as much money in the plan for as long as they can to be as comfortable as they possibly can be in retirement. So it wants to create as many roadblocks as possible for participants to take out their money prematurely. Loans are typically the first option of taking out money, as they're not taxed and they're eventually repaid at a guaranteed interest rate. So the money that you take out for a loan ends up going back in anyways. So as a plan administrator, what's your responsibility? So while the concept of the hardship is pretty straightforward, the tracking and maintaining of hardship documentation to be compliant with the regulations is actually a common pitfall that we see. Nowadays, most plans operate with transactions being initiated online, so a participant can log on to their account and apply for a hardship and submit documentation. And in some cases, it's the third-party administrator that has the right to approve it, not necessarily the plan administrator. However, as a plan administrator, you need to have documentation of that participant taking the hardship. And as a recommended step, I would recommend that as a plan administrator, you be part of the approval process for these hardships, whether or not the procedure is done online or on paper. We've seen instances where participants are fraudulently taking out these kinds of distributions out of the plan without having a hardship, and this is usually due to a lack of oversight on the plan. And if the DOL ever came in and saw what was going on, again, there's heavy fines and penalties that they would probably look at if there was a lack of plan oversight, because they look at a lack of plan oversight as a lack of fiduciary responsibility, and that's the one thing that they hone in on the most. Additionally, a spot check that should be done is to ensure that all avenues were exhausted before the participant takes out a hardship. Typically that would mean that they've already taken out the maximum amount of loans in the plan, and if there's any other non-plan related way that they could get funding for whatever their hardship was, that they do that. The hardship is really meant to be a last resort to get a hold of some funds to address the financial hardship that they have. And the last reason why we want the plan administrators, well, not why we want, why they need to be a part of the process for hardships, is because there needs to be a control in place that when a participant takes a distribution from the plan, that their contributions are ceased for 6 months after that date of distribution. We've seen situations a few times recently where this hasn't occurred, and usually the IRS's protocol for addressing this is to either discontinue the contributions from 6 months after the date of that discovery that you haven't been doing it, or give the participant an opportunity to refund that hardship into the plan. And I can tell you, odds are, if they're asking for the hardship to begin with, there's a very small chance that they're going to be able to refund that hardship back into the plan.
So continuing along the thought of some common issues we see in the plans, another big ticket item from the DOL perspective is remittances of employee contributions. The Department of Labor has some pretty clear rules on how this works. And the rule is that they require that the employer deposit employee contributions to the trust as soon as the employer can. However, in no event can the deposit be later than the 15th business day of the following month. But remember that the rules about the 15th business day isn't a safe harbor. It's really just it's the set of what the maximum deadline could possibly be. The DOL does, however, provide a 7-day safe harbor rule for employee contributions to plans with fewer than 100 participants. So if you're out there and your plan has fewer than 100 participants, you can default to this 7-day safe harbor from the time it's withheld to the time it is remitted to the trust. However, if you have over 100 participants, this 7-day safe harbor doesn't apply, and you're supposed to do it as soon as administratively possible. So some examples of things we've seen in this area is we've seen where an employer might be paying their employees weekly and withholding the 401k contributions weekly, but they only remit those to the trust at the end of each month. That is not in compliance with the DOL regulations. Another one we sometimes see is that there might be multiple companies, multiple payrolls, and they might be paid at different times. Some employees might be paid bi-weekly, others monthly. And again, they're just gathering all the contributions at once and remitting those to the trust. That again is not in compliance with the DOL regulations. However, sometimes there could be a reason why it wasn't remitted as soon as administratively possible. There might be you were changing your payroll system, you were changing your 401k provider, so there was a blackout period and you couldn't remit the funds. It could be severe weather that interfered with operations, among some other examples. However, the reason can't be that so-and-so in charge of payroll was on vacation for a couple of weeks, so we didn't really have a backup plan of how to handle it, or we had a firm outing that week, so we didn't really get the remittances over. That probably won't hold up in the case of a DOL audit, and they might look at having the employer put in for lost earnings on these remittances. However, when you do have a reasonable exception, you should put a memo in your files to document what occurred, what was the reason for it. I mean, oftentimes, if you're going to get flagged for the DOL, it's probably not going to be a week after this happened. It might be a year or two or several months later, and it's good to have a memo in the file that can support it in the case of audit. Another issue we see is in the enrollment front, and it usually revolves around automatic enrollment. So while it's great to get participation rates up, and oftentimes this helps reduce discrimination testing failures, you need to make sure your system can handle it. We often see plans implement auto-enrollment, and then certain employees are put in too late, or there are inconsistencies with the process of enrolling the participants. When participants are not entered timely, it can be costly to both the employer in terms of the time spent correcting it, and also in terms of the dollars that are spent contributing to the plan for these missed opportunities. Another thing kind of in the same line of thought is auto-escalation. So you see a lot of plans out there that have automatic escalation clauses where participants can elect to increase their deferral percentage automatically each year by a certain percentage until they reach a certain max percentage. This is beneficial to participants so that they can time it to have their percentage increase around the same time as their annual pay increases, so they don't get used to the additional income. However, adding this clause causes the need for more oversight to make sure your systems can adequately handle this additional feature. We also see occasions where eligibility requirements aren't strict enough. For example, if you're a staffing company or an industry that has a lot of turnover, you don't want to have a short eligibility requirement. You don't want it that on day one everybody's eligible, but these employees might be turning over every 2, 3, 6 months. Because what's happening, not only is there the administrative task of having to get these people in the plan over and over again, and then they're not even going to be a long-term employee, but it also might skew your discrimination testing results, and it could also put you up over the 120 participant threshold, which triggers an annual audit. We've had clients over the years where the number of eligible participants is well over 100, but there's only 20 people participating, and that's because they might have high turnover and the people are eligible on day one, and it's causing that number to go up, but then they're not actually ever even enrolling in the plan. So you might want to consider designing your plan to cover the employees that it's intended to cover, while also following all IRS and DOL guidelines. Once your plan, as I just mentioned, once your plan reaches 120 eligible participants, an annual audit is needed by an independent CPA until that number of eligible participants is below 100 on the first day of the plan year. And we'll get into these rules in a little more detail later in the presentation. So from the plans we surveyed, 43% currently have auto-enrollment. And again, it's great to encourage participation. It helps highly compensated individuals keep their money in the plan. So in other words, higher participation and higher contributions by non-highly compensated employees makes it easier to pass annual discrimination tests. The most common initial contribution percentage we see is 3%, but there is pretty decent variety. And often these plans combine automatic enrollment with auto-escalation. So participants might be automatically enrolled at 3%, and then it goes up 1% each year until a certain cap, which might be 5 or 6%. And then from there, the participants must make the change themselves online or in person. But again, it's key to making sure that if you do have this feature, that it's being followed properly and participants aren't missing out on this opportunity in the background. So auto-enrollment is really, you can kind of do a pros and cons list, but the big pros are that it increases participation, which on the flip side might reduce the discrimination testing failures your plan might have each year. It also simplifies the investment selection processes. Typically, these contributions under an automatic enrollment provision default to a life cycle fund based on the expected year of retirement. So it sort of eliminates that confusion for your employees if they're not taking the time to sit with an advisor. Also, oftentimes participants are less likely to opt out of enrollment than they are to choose to enroll in a plan that doesn't have automatic enrollment. So you're kind of taking the decision-making process away from them if they're just not getting around to filling out the paperwork. And from a financial standpoint, it's obviously healthy for employees to be saving for retirement as soon as possible so they can benefit from the time value of money. However, with these pros, there are also some drawbacks with automatic enrollment. So while plan management won't need to continually remind employees to enroll since it's automatic, they will have to focus more time on ensuring employees are being automatically enrolled properly. And in order to do that, you really need to have strong systems in place to ensure participants are not being enrolled late or not enrolled at all. As we mentioned earlier, this can result in additional time spent correcting the failure, and it can also cost the company money in terms of corrective contributions. We see it a lot where plan sponsors, they have the right attitude that they want to do what's best for the participants, but for whatever reason, they just might not have the right system in place in order to properly implement it. So you really want to weigh this out and make sure your system can handle it before you go down that road. We've seen plan sponsors go down this road and they have automatic enrollment for a few years and they have all sorts of timing issues and they spend all this time correcting it, and then they ultimately end up deciding to get rid of automatic enrollment. And I'm not encouraging that people get rid of automatic enrollment, but you just need to make sure you can handle it.
So as Jim mentioned, the auto-enrollment is a really good feature for avoiding the non-discrimination test. It helps the highly compensated people from failing, and adding the auto-escalation feature is actually a strengthening feature to the auto-enrollment, especially if you have a company that has high turnover and, you get a lot of people that get auto-enrolled and then leave the company, and then what that does is kind of put you back in the same boat you were in before. So having the auto-escalation clause in there can help make sure that you're strengthening the results of the plan and discrimination testing such that the highly compensated people won't have failures. The other ways to avoid the non-discrimination testing is to increase your employer contribution. Make that benefit a more attractive feature that makes people want to join the plan. A lot of participants aren't educated when it comes to retirement and the 401k plan, and they're not able to see the value of getting the free money that is the benefit of an employer match. So employee education is really important. We encourage you to sit down with employees, whether it's on their day to hire or whether they've been there for a year, having, frequent seminars from the benefits department to make sure that they understand, how valuable of a tool this is for them, not only now, but in the future. The other option to avoid non-discrimination testing, as I mentioned earlier in the presentation, is to become a safe harbor plan. With the safe harbor plan, you're usually matching 100% of employees' deferrals up to 3 or 4% of their compensation, and that money becomes 100% vested. So while it's a very, very good benefit to the employees and it avoids any failure of non-discrimination, it is a very expensive route to take, and we don't recommend that unless you're a highly profitable company with a significant amount of cash flow, because it's something that you're funding all throughout the year. It can be a high dollar expense on your P&L.
So we've been throwing around the term audit a lot throughout this presentation, and audits they come from a couple of different places. So one, you might be audited by the DOL or the IRS, and the other is your outside CPA performing a financial statement audit. So with the DOL and the IRS, they don't audit every plan. I mean, they can't. There's just too many plans out there, so they don't have the resource. So, or the IRS might audit your plan at random. From the DOL standpoint, generally they're selecting plans for audit due to some triggering events such as an incomplete 5500 filing, participant complaints, referrals from the IRS, kind of letting the DOL, kind of tipping the DOL off. So having strong procedures in place and proper documentation will always ensure any IRS or DOL audit can go as smooth as possible. Once they're in there, obviously you want to move things along and get things out as quickly as possible and hope to avoid any potential penalties or fines. On the financial statement side, so these are performed by an independent CPA firm who is selected by the trustees or management of the plan. In these audits, the CPA is expressing an opinion on the financial statements of the plan. So that's what Marty and I at Gray and Gray, we do a lot of these plans every year. And so we're auditing the plan financial statements, and we're also looking at how the plan is operating, ensure it's operating in accordance with the plan document. And we'll get into a little more details about these two types of audits in the next couple of slides. So on the financial statement audit, again, performed by an independent CPA, this is all a result of ERISA. So ERISA is a law that was put in place in the 70s, and the DOL is charged as being the watchdog, the enforcer of ERISA. And what ERISA establishes standards and provides protection to the individual participants of the benefit plans. And key here is that eligible participants include all current employees who are eligible to join or have already enrolled, as well as former employees who still have a balance in the plan. So sometimes we see sponsors confuse this where they say, okay, well, there's 150 people here everybody's eligible, but only 20 are contributing, so I don't need an audit because I only have 20. That isn't the case. As soon as you're over 120 eligible participants, an audit by a CPA is required. If you have a case where it's a newly formed plan, then this number is actually 100. And lastly, you can't get out of the audit once you're in the audit until you're below 100 eligible participants on the first day of the year. This is what is commonly known as the 80-120 rule. The point we made earlier about ensuring the eligibility requirements match your workforce, it comes into play for the annual audit requirement. If your plan has a low participation rate of below 100 employees, but 120 or more eligible participants trigger an audit, you may want to consider amending the plan document to reduce the number of eligible participants so you no longer need an audit. An example of an amendment you could make would include lengthening the service requirement. This amendment, however, would have to be in compliance with DOL and IRS regulations. You can also encourage former employees who still have money in the plan to roll over the funds to their new plan, or you can exercise an automatic cash-out provision. With an automatic cash-out provision, the plan document outlines circumstances where terminated employees have their vested balances automatically distributed to the participant, and therefore they will no longer be a participant in the plan, and then you're getting your total eligible participant count down to hopefully get out of the necessary audit each year.
So what happens when the DOL does come knocking for an audit? You could be selected at random. You could also be selected because there's several red flags. Now, typically, there should be a meeting where you have an investment and oversight committee periodically and review any discussions that are documented around the plan, and any discussions that are documented around the plan should have a review of the investment performance, the selection of the investment options, monitoring of the investment policy, evaluation of your service providers, reports from the plan administrator, any employee complaints or concerns that come to light. All of this should be documented and put into minutes, because when the DOL comes to look at you, that's one of the first places they're going to look to see how the oversight of the plan is run. They want to make sure that you're compliant with all the ERISA regulations, so they're going to come looking for plan documents, 5,500 filings, any contracts that you have. So it's really important that you have a nice, robust trail of everything that is done to either operate the plan or oversee the plan. The Form 5500 that they come for, it's required to be filed by all 401k plans, whether they're audited or not. But as Jim mentioned, under 120 participant plans, they file a small plan, and over 120 is a large filer. And if you're over 120, that's when you trigger the audit. Now, like I said, the DOL audit could come resulting from your financial statement audit, or it just could become your random plan picked in the system. But any plan that's registered is subject to an audit. So at this point, we're going to take some questions. It looks like we have a few questions, so we'll just go in the order that we see them. So the first question we see is the hardship distribution the same as taking out a loan in the plan? They're actually very different features. The loan is borrowing money against your own balance. So you would borrow, I believe the rules are typically you can borrow 50% of your vested balance up to $50,000. And that money, when it's taken out, you receive a check for it, and then typically you repay that loan at prevailing interest rates, and the way you repay it is typically as a payroll withholding. The hardship is a one-time distribution that you take, and that's subject to a 10% tax. When you take a loan out, you're not subject to any tax on that. It's merely just a loan that you're repaying with interest to make sure that you're getting some guaranteed earnings on that money that you had taken out while the money was sitting outside the plan.
One of the other questions we have here, my advisor tells me to remit my employee 401k withholdings by the 15th of the following month. Is this okay? So we touched upon this a little bit earlier, and that technically is not meeting the criteria most likely. So if your plan, and I don't know the size of your plan, but if it's under 100 employees, then you need to make sure you're doing it within the 7-day safe harbor rule. If you're over 100, then you should be doing it as soon as administratively possible. Now, if for some reason the 15th of the following month is as soon as administratively possible, maybe you could make a case, but I would often think that this day and age it could be remitted much sooner than that.
Another question.
Another question here. My plan is not large enough to need an audit. Do I still need to file a 5500? And I think Marty actually just answered that, so that might have come in a second before we finish. But Marty, you want to answer that?
So no.
Yes. So you do still need to file a 5500, even if you're a small plan, regardless of the plan. You do need to file, whether you're a large filer or a small filer. In the case of a large filer, that's when you're also including an audited financial statement from an independent CPA with the filing. The small filer, The 5500 is not as lengthy. It's an easier submission, but it is still absolutely required.
So I don't see any other questions on here. We hope you found this webinar worthwhile. We know it was a lot of information, a lot of compliance-related stuff, but everything that we talked about was a function of the results that we saw in the survey. And if there's any other questions that you want to ask us, please feel free to ask us online. Also encouraging, if you have any questions on the survey that you'd like to see asked on a given year, please send that over. We're always looking for ways to make that survey better. So if there's nothing else, we thank you for taking the time to listen to us today, and we hope you all have a great day.